Thank you, Rachit, and good morning to all the participants. Welcome to this webinar on carve-outs in India. Thank you all for joining in. I'm Vinit Desai. As Rachit mentioned, I and my colleague Shripal will take you through this insights on carve-outs in India. As mentioned by Rachit, we have divided our session into four parts. Part one, overview of carve-out and market trends, where we will discuss the what and why of carve-outs and also discuss market trends basis a recent survey on global M&A activities. In part two, we'll be doing a bit of more deep dive into the various modes of carve-out. In part three, we will look at some of the important considerations for a carve-out, including certain latest tax amendments. And here we will also discuss certain interesting case studies. And in part four, we will take up any questions which you all have at the end. So, moving to part one, which is objectives of carve-out. Let's look at what is a carve-out first. It means to take something from a larger whole. It includes sale or hive-off of a specific division or a profit center of a business. So from a commercial perspectives, carve-outs are often carried out for one or more of the following reasons. One, monetization or fundraising from potential investors. Now, if we look at as an example, Adani Enterprises is a flagship entity of the group which incubates various businesses, and then once they are reaching at a mature level, the businesses are hived off. Thus, today we see a large number of listed companies in the group which are part of this objective of fundraising. Second, de-risk or focus on core business unit. Here, if we look at recent announcements, L&T Group has announced that they would like to divest their non-core assets such as power and road assets so that they can focus on their core business. Business model transformation. Here, if we talk of an example, Apollo Group in the past has hived off its pharmacy business on the basis that pharmacy business had already reached a mature stage and they wanted to take it to a next level, such as digitization. Fourth, regulatory requirements. Now, we have seen in the past that, Competition Commission of India, for example, has advised the companies to carve out some of their businesses if they see an adverse impact on competition in India. Similarly, there are companies who are looking at carve-out as an option to deal with the requirements under foreign direct investment regulations for multi-brand retail. ESG considerations. I think this is one of the common topic in the boardroom now. Here, if we look at as an example, Mahindra Group has recently announced hive-off of certain assets into a new company to form an electric vehicle JV. And this joint venture will be with the British government arm, which is called British International Investment PLC. So as we see, carve-out represents an opportunity to focus on core assets, improve the overall value. Carve-outs require considerable planning and careful execution to navigate the risk to the sellers, buyers, and the entity from the perspective of business, regulatory compliances, and tax. If we look at certain market trends here, there was a survey carried out in 2022, 2021 by Deloitte. It was a global survey on 1,300 executives across large corporations and private equity players to gain a perspective on market trends on M&A activities. It's interesting to note here a few of the findings of the survey as they relate to carve-out. The survey found that nearly 89% of the senior executives had either witnessed a carve-out in the last 12 months or were going through a carve-out at the given point of time. This is reflected in the pie chart on the left side. Similarly, when inquired to the extent that your company is currently pursuing transactions, Which of the following you are most interested in exploring? Out of the various modes of M&A transactions such as JV, strategic alliance, SPAC, acquisitions and divestitures, survey indicated that there was an increased interest in carve-out as a mode of M&A in the last couple of years, climbing 8% from 2019 to 2021. India itself has also seen several carve-outs in last few years. Let's look at what are the alternative options for carve-outs as far as Indian regulatory and tax environment is concerned. Generally, carve-outs are carried out through one or more of the following methods. Option 1, demerger. Option 2, slump sale. Option 3, itemized sale. And option 4, in certain cases, even share sale. I will now request Shripal to help us deep dive a bit on each of these options.
Thank you, Vinit, and good morning, everybody. Just going to the first one, demerger. Demerger essentially would involve transfer of a business from one company to another company, and demerger would essentially it's carving out from the company. The company we call it as a demerged company, and the company to which the business is transferred is the resulting company. Now, demerger would essentially involve transfer of all the assets and liabilities from the demerged company to the resulting company, and like in case of a demerger, the company which is transferring the business would not receive any consideration, and consideration is discharged by the resulting company directly to the shareholders of the demerged company. Now, the demerger has been would be tax neutral. From the day the demerger concept was introduced in the law, there are conditions which are prescribed, which which have to be complied with for demerger to be considered as tax neutral, both in the hands of the demerged company, the resulting company, as well as the shareholders. Now, to be tax neutral, there is a section under the Income Tax Act, Section 219AA, which lists down the conditions, and those conditions have to be complied with. Now, some of the important conditions which are there are all the properties and liabilities of the demerged undertaking become properties and liability of the resulting company. In essence, all the assets and liabilities relatable to the undertaking have to be transferred. Now, consideration is discharged by way of issue of shares to the shareholders. So there's a direct issue of consideration to the shareholders. The third condition, which is also linked to issue of shares, is at least 3/4 in value of shares, at least 75% or more in value of shareholders of the demerged company become shareholders in the resulting company. And the last and the most important condition is that the transfer has to be by way of a going concern. Now, if all these conditions are complied with, then one can say that the demerger would be tax neutral in the hands of the company, in the that companies, which is the resulting company and the demerged company, as well as the shareholders. Now, demerger is a fairly lengthy process. The total approval process would be about 10 to 12 months. This requires approval of the NCLT. We have had few instances where there can be a short form demerger where the regional director can approve the demerger process, but there have been very few instances thereof. Now, some of the key considerations when it comes to demerger is you cannot demerge a asset which is which or a group of assets which do not constitute an undertaking. It is important that what is being demerged is a business undertaking as a whole. Now, the term undertaking is defined in the Income Tax Act to include a part of an undertaking or a division of or whatever is being there has to be a business as a whole. An individual asset or liability or a combination of assets or liabilities which do not constitute a business would not be considered as an undertaking. This is a very important consideration because this becomes subject matter of litigation where tax authorities believe that what is being transferred is not a business. Second is as regards carry forward of losses, there are specific provisions in the Income Tax Act which provide for whatever is the loss which is relatable to the business would get transferred from the demerged company to the resulting company. There would be no GST implications on transfer of an undertaking. The demerger per se would not attract GST. And last, stamp duty, the demerger order is a conveyance order and would attract stamp duty. The stamp duty would depend on the value of shares issued and the state in it with the properties are situated. Moving on to the next slide, slump sale. Okay. So slump sale is also one of the modes which is prescribed in the act for transfer of business. Now slump sale, as it says, slump sale is defined under the Income Tax Act as sale of one or more undertaking for a lump sum consideration without assigning values to individual assets and liabilities. The essence of slump sale is it also has to be a transfer of a business for a lump sum consideration without assigning values. So we cannot assign values. If we assign values to individual assets and liabilities, then it would not be regarded as a slump sale. Now, the Act has also provided chargeability for slump sales. So any gains arising on transfer of a business by way of a slump sale would be subjected to tax. Now, the tax would depend on whether the undertaking or the business which is being transferred is held for a period of more than 36 months or period less than 36 months. If it is held for a period more than 36 months, it would be considered as a long-term capital asset. And if it is less than 36 months, a short-term. And the tax rate also accordingly will differ. In one case, it will be long-term capital gains, and in another case, it could be short-term capital gains. Unlike in case of demerger, in case of a slump sale, per se a court approval or an NCLT approval is not necessary. However, we have observed in past that there are some corporates who prefer to even get the slump sale approved through an NCLT process. Essentially, these are the schemes where there are several regulatory approvals required, and they believe that if we have an order from a court, then transferring those regulatory approval becomes that much more easier for them. But if you do not approach NCLT, then it's possible to conclude a slump sale within a period of 2 to 3 months. Similar to demerger here also, the undertaking test, what is being transferred should constitute a business undertaking. Undertaking test is very important because the transfer has to be on a going concern. Here also the GST Act provides that there will not be any GST levy on slumps on a transfer of a business on a going concern. Stamp duty once again will be applicable, and it will be dependent on the state in which the assets are situated. And the losses, unlike in case of a demerger, the losses do not get transferred. So the tax attributes of the demerged company would be retained with the demerged company and do not get transferred to the resulting company. If you can move to the next. Yeah. Itemized sale, this is essentially transfer of assets, where the consideration is fixed and the values are assigned to individual assets and liabilities. One can also say that this is cherry picking of assets. And in case of an itemized sale, normally the undertaking criteria is not important. And the capital gain tax in case of an itemized sale would also depend on whether the assets are held for a period or long term or short term, that is they are held for a period of 36 months or more or less than 36 months. And the capital gain tax would also depend on whether the assets are depreciable or a non-depreciable asset. In case of a depreciable asset, and the block ceases to exist, it would be considered a short-term capital gain, which could trigger a tax of 22 to 30%. And here also no court approval is necessary, and one can easily conclude a transaction by doing an agreement or a document between two parties. This will attract stamp duty, and GST is also applicable on the assets transfer. Last over here is on the share transfer. So acquisition of whole or part of the shareholding in a target company. So this is also one way in which a carve-out is being done. Essentially, when the business is held as a subsidiary, and gains arising on sale of share is taxed as either long term or short term. In case of securities, shares, the period for reckoning whether it is long term or short term is 24 months. So if it is held for a period more than 24 months, it would be long term, and if it is held for a period less than 24 months, it would be short term. The capital gain tax rate will depend on whether the resident seller or a non-resident seller. In case of a non-resident seller, in case of a short term, it can be 40%, and in case of a long term, it can be 10%. And similarly for residents, the long-term rate will be 20% plus applicable surcharge, and short-term could be ranging from 22 to 30% plus applicable surcharge. Some of the important considerations in case over here are deemed gift tax provisions. So we have a recipient taxation provision under the Income Tax Act under section 56 to 10. And one will have to ensure that it is at a value higher than the deemed fair value. Otherwise, these would be applicable. In case of a seller from Singapore, Mauritius, treaty benefits have to be evaluated, and one will have to see if the seller is claiming a treaty benefit, whether there is a need to obtain an insurance, pricing guidelines under FEMA, if in case either buyer or seller are residents or and non-resident, then the pricing guidelines also have to be complied with. Indirect transfer implications in case of transfer of shares will have to be evaluated in case of sale by non-resident. And if there's a transfer of shares of a company outside India, which results into transfer of shares of an Indian company indirectly, then these implications will arise. Now, surcharge on long-term capital gains is now reduced to 15% for individuals from 1/4/22. Earlier, the peak surcharge was 37%. And stamp duty is applicable at the rate of 0.015%, plus the state stamp duty is payable. So, there are a lot of considerations here. Moving on to the next slide. Some of the other key considerations which are there, like the succession. So in case of a succession, in business where the predecessor cannot be found, or taxes cannot be recovered from predecessor, then the successor would have the liability to pay taxes. This is provided in the Income Tax Act. Now, in case of a slump sale or a demerger, given that it is a business transfer and the transfer is on a going concern basis, there is a risk on the purchaser to be viewed as a successor, and hence a succession risk may devolve on the purchaser. Similarly, Section 281, so there is a requirement from obtaining a no objection certificate from tax authorities in case of transfer of assets where there are pending tax proceedings. So if any company which is part of, say, which is the transfer or company in case of a demerger or a slump sale, and there are pending tax proceedings, then under the act, there's an obligation for the company to go and seek a no objection certificate from the tax authorities. And if the no objection certificate is not sought, then there's a risk that the tax authorities could consider the transaction as void. And therefore, it is essential that whenever there's a slump sale or a demerger, one should go and seek a no objection certificate from the tax authorities. Coming to the second part is taxability of contingent consideration. In certain cases, the parties agree to a lump sum fixed consideration as well as a contingent consideration payable at end of a specified period post the transfer of business. The contingent consideration may be a fixed amount or maybe a variable amount which is linked to achievement of certain milestones or in the company, which could be revenue, EBITDA, etc. Now, the tax treatment of contingent consideration has been a subject matter of debate, and it has been litigated in past. There is a Bombay High Court ruling in the case of Hemal Raju Shetty, which has upheld that the contingent consideration should not be taxable in the year of transfer, but essentially should be taxed in the year in which the same is received. However, a contrary view is also there from the Delhi High Court in case of Mr. Ajay Gulia and Madras High Court in case of Anurag Jain. My two bit on this is if it is a mere deferment of consideration, then it should be taxed in the year of transfer. However, if it is variable and it is not possible for somebody to determine what would be the consideration, then it should be taxed in the in the year in which it is received. Now, third is commercial rationale for carve out, and the main purpose of doing any restructuring uh, should be something that should not be done with an objective of attaining a tax benefit. GAR provisions have been there in the statute, and the arrangement should not be considered as an impermissible avoidance arrangement. If the tax authorities conclude that you've done this arrangement of doing a carve out or a slump sale or a demerger only with a view of minimizing the tax liability and there was no business rationale, then the GAR provisions could trigger. Uh, the last two are allocation of debt and approval of sectorial authorities. So allocation of debt. So whatever is the debt which is allocable or relatable to the business have to be transferred. And in case of demerger, the section does provide that if it is an identifiable debt, then that identifiable debt should be transferred. If something is not identifiable, then it should be transferred in the ratio of assets transferred. Whether there have been some debates around this, and Vinit will take a case study around this. And the last is sectorial authority approval. Now, whenever any demerger or slump sale, etc., is undertaken, one needs to be very clear, whether this will require approval of sectorial authorities, and if any sectorial authority approval is required, then the same should be sought. In particular, if we are say a road asset is proposed to be carved out, or if any petroleum assets are proposed to be carved out, they would certainly require approval of NHAI or Ministry of Petroleum and Natural Gases. So these considerations will have to be kept in mind. I'll request Vinit to take up some of the recent tax amendments.
Thank you, Shripal. We will now look at some of the amendments in last couple of years which have impacted carve-outs. First is goodwill, no longer an intangible asset. So in the past, goodwill was an intangible asset recorded by the acquirer in case of business purchases on which they would going forward claim tax depreciation. This was one of the important consideration from an acquirer perspective when they are evaluating deal price, as it directly had an impact on their IRR given the tax savings. Effective 1st April 2020, in Finance Budget 21, the government announced that goodwill of a business or a profession will no longer be considered as a depreciable asset. Hence, no depreciation shall be allowed on goodwill for the acquirer. Now, this impacts all the transactions which will happen and which have happened since 1st April 2020. Plus, it also has an impact on the transactions which would have occurred prior to 1st April 2020. Acquirer would have recorded goodwill, started claiming depreciation, and the WDV, which is a written down value of that goodwill, still existed as on 1st April 2020. The amendment required that the parties do not claim depreciation on goodwill going forward, even if the transaction was consummated prior to 1st April 2020. Effectively, directly impacting the IRR of the acquirers, even for the transactions of the past. In light of this amendment, it is imperative to analyze if acquiring entity allocates value basis a purchase price allocation to other intangible assets, such as customer relationships, brand name, non-compete, etc., whether these assets could be constituted as an intangible asset for tax purposes, and if depreciation could be claimed thereon. Now, it could be arguable that some of these assets are in the nature of similar business or commercial right, which is specifically mentioned in section 32, and therefore would be eligible for depreciation. However, since it is a generic language in the section, and these kind of intangibles are not specifically mentioned, it will have to be a fact-based analysis as to whether a particular asset can qualify as a similar business or commercial right and therefore subjected to depreciation. It will thus become a debatable issue, and risk of litigation cannot be ruled out unless there are precedents of High Court or tribunal which are specifically on those kind of assets. Let's look at the second amendment. This again came up in the same Finance Act 21, where the definition of slump sale was amended to expand its scope to cover all forms of transfer stroke sale under slump sale, including slump exchange. Now, what is the impact here? In the past, there were rulings and there were corporates who were taking a position that if a transaction is consummated by way of slump business transfer, where the consideration is not in the form of cash and it's a non-monetary consideration, it is not a slump sale and therefore should not be subjected to tax in absence of any specific provision in the act, and on the basis that the computation mechanism for capital gains on such a slump exchange itself fails. The ruling, the famous ruling on this aspect is in the case of Bharat Bijli, where the tribunal positively observed that such a transaction should not be subject to tax. Given this amendment, I think this ambiguity now comes to an end, and any slump exchange will be subjected to tax going forward under section 50B in a manner similar to any other slump sale. The third amendment, it's around TDS and TCS. Now, Finance Act introduced a concept of tax collection at source and tax deduction at source at the rate of 0.1% on purchase and sale of goods. The natural question which came up was whether, in the context of carve-outs, whether a business or undertaking can be considered as goods for the purpose of such TDS or TCS provisions. Now, while there is no clarity in law in terms of the act or the circular, basis definition of goods under various other acts such as Central Goods and Services Act 2017 and various state specific sales tax and value added tax rulings, a view can be taken that a business or undertaking does not qualify as goods, and hence TDS as well as TCS likely should not apply on transfer of business or an undertaking. The other important amendment which came up in few months back is regarding the deemed consideration for the purpose of capital gains tax computation on slump sale. So, as we know, there were provisions for computation of deemed capital gains tax in the context of various other properties such as shares, securities, immobile properties, etc. However, there were no provisions to determine sale consideration in the context of a business transfer or a slump sale. Recently, by way of rules and amendments to the Act, a framework has been brought in whereby one has to compute fair market value under two scenarios, and higher of the two will be considered as sale consideration for the purpose of capital gains tax computation on a slump sale. The fair market value 1 is more akin to adjusted book value because it talks about book value of all the assets except certain specified assets, which is jewelry, artistic work, shares, securities, and immobile properties. So any other asset other than the five assets which I just mentioned have to be considered at book value. Then you look at fair value of these five assets, which is jewelry, artistic work, share securities, and immobile property, added to the book value of other assets, less the liabilities, and that brings us to an adjusted book value, which is FMV1. Now, for this purpose, the shares and securities have to be valued in a manner similar to Rule 11UA, which is akin again to book value of the company with certain specified adjustments. Immobile property have to be considered basis the stamp duty ready reckoner value of such asset. FMV2 is value of monetary consideration received or accruing plus the stamp duty value of the immobile property plus the fair market value or the value that any other asset which is part of the sale consideration will fetch in open market based on a registered values report. So essentially FMV2 is more relevant. So FMV2 gives us a price of the sale consideration in cash plus FMV of any non-monetary consideration. Once we arrive at FMV1 and FMV2, the higher of the two will be deemed to be sale consideration for the purpose of capital gains tax computation. So in case the consideration, the actual sale consideration is lower than this derived number, then there will be a deemed capital gains tax considering the such higher sale consideration. Now let's look at a couple of case studies having studied the various tax and regulatory nuances. It will be interesting to see a couple of case studies where carve-out was relevant. Case study 1, the facts are that X Limited wants to transfer a hotel business to Y Limited for an agreed lump sum price. The business includes certain land, building, furniture, equipments, license for lodging, boarding, etc. However, liabilities in relation to the undertaking were not envisaged to be transferred as part of the transfer of assets. Now, the question could be whether non-transfer of liabilities will vitiate the undertaking argument for slump sale purposes. Cochin Tribunal, in case of Ooty Gate Hotels, evaluated a similar matter. The taxpayer made a claim that it was a case of asset sale as the agreement mentioned that only land and building were proposed to be transferred for a lump sum price. Tribunal, however, observed that in order to understand whether the sale was a slump sale or a sale of independent item of assets, it is necessary to examine the intention of the parties to the sale agreement. If the business of the vendor is sold as such as a going concern with all essential and integral assets and liabilities, it is a slump sale and should be taxed in accordance with the section 50B. There are similar views also taken by other tribunals in the past where they looked at the substance of the agreement and concluded that it was a case of business transfer in spite of the agreement not specifically saying that it's a business transfer. Deriving an analogy from this, if certain assets or liabilities are not transferred, I think the question to be asked would be whether such asset or a liability which is not transferred is an essential or integral part of the business which is envisaged to be transferred. Can the acquirer run the business on day zero itself with the assets and liabilities which it is taking over without the retained asset and liabilities? And basis that a view will have to be taken whether this not transfer of one of the asset and liabilities will impact the undertaking argument and therefore the definition of slum sale. I will request Shripal to take case study 2.
Thank you, Vinit. So your the facts are A Limited is a company and it has got two units. The unit one is a manufacturing unit, and unit two essentially is an investment undertaking, or one can even consider that it has got other businesses which are held through the SPVs. You could have business such as say power or road, etc., where essentially every new venture is done in a separate SPV, and the A Limited is proposing to demerge say unit 2, which is the investment undertaking, into B Limited, another company, and this is proposed to be by way of a demerger, where shares would be issued by B Limited to shareholders of A Limited. Now the question over here which arises, and which links me back to what I had mentioned earlier, whether the investment would qualify as an undertaking. As we discussed earlier, undertaking is a very important criteria, and whether investments in a company or investment division or an investment undertaking would be considered as an undertaking for purpose of demerger. Now, this is a very debatable issue, whether investment can be regarded as an undertaking or not. When if it is a pure investment activity where you're just buying shares in a company or buying certain financial assets like mutual funds, etc., unlikely that it would qualify as an undertaking. And a better view would be that investment activity is not an undertaking. In fact, there have been certain litigations which are ongoing, and therefore I'll avoid taking names. But the Bombay High Court and the tax authorities have kind of concluded to say that investment activity may not be regarded as an undertaking. And also when I say Bombay High Court, Bombay High Court in the case of Brook Bond, of course this was a case law in the context of Companies Act, but had very clearly laid down that investment activity is not a business undertaking. This was in relation to transfer of an undertaking under corporate law under the erstwhile provisions of 1956 Act. But I would believe that the rationale which was there in that judgment in the case of Brook Bond would still squarely apply. In one case, which is ongoing, the tax authorities have questioned, challenged, and the matter is currently subjudiced. And we'll get to know in terms of what the judiciary believes from a tax perspective, whether investment would be an undertaking or not. But the better view would be that investment should not be considered as an undertaking. And therefore, if it is not an undertaking, if one were to do a demerger, then and issue shares, then it would not be entitled to the tax neutrality. Both the demerger would be taxable as well as the receipt of shares in the hands of shareholders would be taxable. So I think that brings us to an end on our current. Happy to take up questions between me and Vinit. So if there are any questions.
I will request participants, if there are any questions, please post it on chat box and we'll be happy to answer. We have 10 minutes. Okay, we have one question. Please throw some light on applicability of GST on slum sale. In context of slum sale, though the GST law is recent, however, there are various rulings in the context of sales tax and value added tax, whereby a view can be taken that if a business is transferred on a lock, stock and barrel basis, it is not goods, and therefore GST should not apply. It is neither goods nor services, and hence GST should not apply to a slum sale.
Mhm.
Okay, another question, how provision of section 194Q will be seen in the case of slum sale? So I think what is relevant for the purpose of 194Q is whether a business is goods, and similar to what we just discussed for GST purposes, basis various rulings in the context of other laws, as well as the definition of goods in the context of GST and other laws. It can be said that the business itself is not goods, and therefore on transfer of a business undertaking, section 194Q, which is more relevant in the context of uh, purchase or sale of goods, should not apply for a business transfer. I think there is one more question. Is there a difference between a carve out and a spin off? So, see, they are not defined terms. So, carve out as well as spin off have been loosely used, but they all mean hive off of a business from one company to another. It's basically the same. Carve out and spin off, to my understanding, is the same. There's no real difference between the two. There is one more question, whether 115 QA is applicable to capital reduction. I think that's not connected to carve out, so we can take it up separately. We may focus on carve out related questions which are coming up. So there is another question on, can you broadly touch upon tax implications on carve-outs between domestic and overseas entities? So, I mean, we need some more detail in order to answer this. On a broad basis, if there is a transaction between domestic and overseas entities, and if they are related parties, transfer pricing provisions would apply, and therefore the transaction will have to be justified to be at arm's length. The price at which the business transfer or uh, any other form of carve out share sale has happened has to be at arm's length, and therefore necessary documentation is required. If they are unrelated parties, then uh, while the transfer pricing provisions will not apply, foreign exchange regulations will have to be still complied with, whether it's related or unrelated overseas entity. And for certain situations, the foreign exchange regulations also prescribe the minimum or maximum price at which a transaction can be done. So, for example, if it's a share acquisition, there are pricing guidelines provided under foreign exchange regulations, and one will have to comply with those. Okay, there is one more question. Will 194Q come into picture in case company goes into liquidation? So I think there are two elements to this. One is what assets are distributed in context of liquidation, and whether we are crossing the thresholds prescribed under 194Q for the purpose of applying TDS on purchase or sale of goods. And accordingly, I think that question can be answered. So basically, if there are any purchase or sale of goods which are happening in the context of liquidation and the thresholds are being crossed, then there is no exemption for company going into liquidation. I think there is a question on please share the case law referred in the last case study. So as we just mentioned, it's still under litigation, and hence we've intentionally not mentioned the name of the company here.
But as regards the case law on whether investment would be considered as an undertaking, this is an old case law in the case of Brook Bond Limited under 293 1A of 1956 Act.
I think there are questions around whether carve-outs are booming in India and what risks are involved in a carve-out. So yes, we have seen and we are increasingly seeing this trend of carve-outs as an option because companies are looking at hiving off non-core assets or monetizing it, especially in the due to the pandemic and the post-COVID situation. We are increasingly seeing carve-outs as a mode of M&A. What risks are involved in a carve-out? I think from a tax and regulatory perspective, we briefly touched upon all the risks which have been there in the context of carve-out. There will be, of course, operational issues which will have to be considered when one company looks at a carve-out in terms of how integrated or disintegrated the division is which one is looking at carving out, and what are the interdependencies and how to resolve those interdependencies at the time of carve-out.
The other question is what will happen to carry forwards in case of carve-outs? So we touched upon this at or earlier part of the session. In case of a demerger, if it qualifies as a tax neutral demerger, then all the losses relatable to the business undertaking would get transferred. Whereas in case of a slump sale or an itemized sale, etc., the tax attributes do not get transferred and they would continue with the transfer or company.
Yeah, so they don't get lapsed, it will stay with the transferor company.
Yeah. And there's a question similar, when we convert a company to LLP, do we get the fresh set of 8 years to carry forward the loss? The answer to that is no.
No, I think fresh set of 8-year period to our mind is only in the context of amalgamation, not in any other context. I think there's one more question around section 56 to 10, whether it will apply to carve out to an overseas entity or by an overseas entity. So basically transactions between a domestic and overseas entity. So I think here we will have to look at the facts in more detail. Technically speaking, Section 56 to 10 will apply if a transaction is happening in India or has nexus to India. So depending on what the exact facts are, whether the situation is such that it can be said that the transaction, for example, is a share transfer, where there is no nexus to India, or whether it's a business transfer where it is happening in India. A view will have to be taken. There is no exemption per se for transaction with where overseas entities are involved.
Now the question is a slump sale covered in restructuring definition to take approval of NCLT? So we've touched upon this also. Slump sale per se does not require approval of NCLT. However, in certain cases, corporates do prefer to go to NCLT and seek an approval. Essentially, these are the cases where there are several regulatory approvals which are necessary. And like if there's an approval of the court, then obtaining those approvals for transfer of business become that much easier. But per se, the answer is no. It does not require approval of NCLT.
Can the carve out happen between India and foreign entity? I think it's subject to foreign exchange regulation. Uh, if foreign entity has an Indian branch and there is a transfer between that Indian branch and an Indian entity, it is possible, and foreign exchange regulations will have to be complied with. Usually, foreign entity directly would not have a business in India. I'm assuming when we look at this question carve out, we are intending of a business from a foreign entity to an Indian entity. So foreign entity, if it is having business in India, it will be through a branch in India, and then a transfer between a foreign and an Indian entity will be possible, and we'll have to comply with the foreign exchange regulations for that. So is the exemption under section 47(4) optional? Transfer of assets from holding company to subsidiary, can an assessee not claim the exemption? So yes, if there is a carve out which is happening from a parent to its 100% subsidiary, it is possible to claim such exemption, and you will have to comply with the conditions for that exemption, including the 8-year lock-in period. So if there is any transfer, change in shareholding, and the 100% relationship given up in any of the year, even a one share transfer of, even if you transfer one share, the original carve out will become taxable from the year when the carve out was actually done, and you will have to incur tax along with interest.
And just to add to that, it is not optional. So if on the day when you're doing the transfer, you're complying with the conditions that you are a wholly owned subsidiary to which the business is getting transferred, uh, that exemption will be made available. So it is then thrusted upon you. And if in the 8 years period thereafter, if any of the conditions in the 47 year are not complied with, then it will, it will become taxable. But if you are complying with the conditions, you cannot say, I will not want to claim the exemption, then that exemption will be given to you. Think. So if the conditions are not satisfied, say after 3 years, there will be tax. It will, there is a mechanism under the act pursuant to which it will be taxed. So, that.
Either there will be a revised return possibility, and I think there were recent amendments to for rectification as well. I do understand the issue here that if the conditions are breached after 3 years, the timeline for revised return would have elapsed. But I think in the recent budget, there was an amendment to permit certain revisions in returns to take care of this situation. In the past, what used to happen before this amendment is in assessment, if the assessment is ongoing, one will have to offer it to tax. But technically speaking, this interest is applicable. The mechanism we have to figure it out.
And the previous question, like, if you're complying with 47 core conditions, then it is not a transfer. And there, if it is not a transfer, it cannot be subjected to tax. And therefore, like, it's not optional to claim that. It's not an exemption, but it's not a transfer.